Vielen Dank für Ihre Bereitheit. Vielen Dank für die Einladung. Ich bin leider nicht voll deutschsprachig. War ein bisschen deutschsprachig, das ist kein Problem, aber ich spreche so langsam auf Deutsch. Und dafür, ich habe keine Zeit dafür, in die 20 Minuten, dass man mich gegeben hat. Ich gucke nur nach die Praxis. Und dafür sehe ich mich die Kontext an und dann schaue ich, was wir praktisch gemacht haben. Ich schalte jetzt auf Englisch. So I'll give you some comments on how we acted within the scope of this very peculiar, very specific context. Can you switch? Next slide. And just a short introduction. In this short introduction, the only thing I want to show you is, well, is it worth listening to this guy? Because so many people will talk about what they think about the world and what they think about the theory and whatever. Now I want to show you in practice what we have done, and show you in practice how we experienced this period and how we created new opportunities. And that's why we chose that title. Turbulent times lead to create special opportunities. In muddy waters, it's good fishing. Yeah? In troeben Wasser is as good anglen. And that's what we have done. Okay, next. This is just an introduction who we are. Of course, the asset management company is PTAM Asset Management. Just switch on. This is just introduction. Every time I tell you switch, just switch. Just like here, I will be showing you the performance that we've had in the last couple of years, just to show you whether it's worth listening to us, yes or no. Just switch. Next. This is PTAM Global Allocation. This is our fund. You see some carve-outs. I don't shy away from volatility. I'm, by the way, the inventor of capital guaranteed funds somewhere in the 90s. So I know how to capital guarantee something if necessary. In this case, it wasn't necessary. This leads to some carve-outs, but overall, we've had a very good performance. Next. Just to brag a little bit, we have 5 morning stars. We have the best among the better or the highest scores in Libra, etc. But of course, everybody can tell you that, and everybody will be very cynical about returns. Just show me if you show the next graph. This is in Bereich. From 97 different balanced funds. Everything which is called balanced neutral is on this graph, 97 of them. This is our performance on the green bar on 1 year, since the beginning of this historical year. Next. This is since 1 year, and the next one, next, is in 3 years. So something what we have been doing must have been good. Something in the madness showed some method and some methodologies. That methodology I want to share with you, and of course also share the results that we've had. Next. First thing, the most important thing is the asset allocation process, of course. But everybody says that 90% of good performance come from asset allocation. I don't agree. Roughly only 50% comes from good asset allocation. 50% comes from individual action as well, individual selection, and I'll be dwelling on this individual selection also. Yeah, next. Asset allocation. I will show you our geographical, sectoral, and thematical considerations. On the geographical base, just to be short, we are mainly focused on the US. And China. These were my 2 main areas. I have nothing else in emerging markets, certainly not Latin America, except for India. That's the only small exception that we make, very much like India, but that's for the really long term. We shied away from Europe, but we're picking up industrial values in Europe for the moment. On the sectorial basis, we only look at technology, strangely enough, and there are some industrial values that are being taken into consideration for the moment. Thematically, it's a more pronounced view that we have. Next. Thematically, we go for robotics, automation, robotics and automation, that was really our luck, because we were already focusing very much before the corona crisis broke out on these two aspects. I have an engineering background somewhere, and in this robotics automation, already 20 years ago, saw the big future. Now, of course, this is more pronounced now. There's no company, no big company crazy enough anymore to have one established head office or one established big production facility somewhere far away in China. You saw what happened to Apple. You saw what happened to a lot of companies which got squeezed in their supply chain. No, they will automate in other and put several locations and go for several locations. And of course, they can only live up with the product costs there. Of course, the labor cost if they're robotized or automized to the full maximum. Biotechnology, I've been in there for the last 30 years, and the next 30 years I'll be in there. Fortunately, I won't live that long, but yeah. Biotechnology this is the key to the future. Of course, you need a big stomach. You need a strong stomach to anticipate all the movements going on there. And of course, this has helped us very much. I was very much interested in network security. Network security, certainly because I've got a background in banking, and I know how much investment is going on in banking for the moment. But the banks are not profiting from that. I would shy away completely as possible from banking investments, but I would go like in 1849. You remember the gold diggers. The gold diggers never found anything except for a couple of exceptions, but it were the people who sold the shovels and the whiskey and the carrots and whatever. They made the money. It's the same thing over here. Who will be making money in the future? Network Sicherheit. Of course, water, Lebensstil, very important for us. And that is, of course, the aging process which is in there. Our patterns of consumption are changing very much. And then, of course, alternative energy, which will become more and more important, certainly if Joe Biden would win the elections. Now, on the elections, you know, the German, of course, the German proverb which says, politische Börsen haben nur kurze Beine. Very much so. This will also will go away, except for if Joe Biden wins, of course, the alternative energy team with First Solar, Tesla, etc., which will be picking up. Okay, next. What are we taking into account? That's what you will see. Everything which is relevant on the business cycle, die Geschäftsklimatprognosen, Zinsprognosen, Unternehmensergebnisse und erwartete Risikoprämie. Next. I'll take that into account. Next. Hello. Next. Sorry about that. Look at the 4 elements that we take into account: interest rates, interest rate differentials, betriebsgewinne, and risk premiums. That's all. That's all we look at. Of course, we look at that in a very in-depth manner. I take out the most important aspects, erwartete rendite und Risiko. I'll take it into an optimization program. This will lead me to an asset allocation where I spread over bonds, equity, etc. This will, of course, be tested with the fact that I always keep a capital guarantee in there over a very long period, which will be 8-9 years, so that I'm always sure to see the money come back within a pronounced period of time. And this will lead me to the effective asset allocation, the effective zuweising. Please next. Please next. On the very low interest rates for the moment, they didn't surprise us at all. We were anticipating very low interest rates, and of course, the corona crisis has only increased the speed downwards. 75% of all interest rate movements are based on demographic patterns. So we already know, and demographic patterns, of course, that's something that you can look ahead into for 20-30 years. That's something that we already picked up. This is a model I created somewhere in the year 2000, where I said we're going for an ice age of interest rate, an Eiszeit von Zinsen. You see that I'm taking a tunnel here, which will lead us into 2030 something. And this tunnel was already very, very, very downward oriented. Corona only speeded up what was going on already in the markets. Just like on the stock market, it only speeded up what was already going on, and therefore stocks like Apple, Amazon, Nvidia, you know all the names, the 5-6 big names which did spectacularly well. It was already written in the stars what was going on, and we were very fortunate to have that in our portfolio. So for the next coming period, don't be afraid of very low interest rates. They will remain low. And for a niche fund, like a niche fund, like our fund, is of course important to also look at what the bonds, what the online will do in the future. Interest rates will remain low, so we are not that afraid that something will go wrong on the duration side of bonds. Next. The next one is the zinspread, the difference. Next. Yeah, next. Very important for us was the evolution on in the Eurozone. Now the Eurozone is stronger than it ever was before. And you also see that in the zinspread, the difference, the interest rate differential. For example, Italy against Germany, Spain against Germany, Portugal against Germany. Italy is the biggest position that we have in bonds. Of course, in Germany, they don't like to hear that, but I've already been advocating this process for a very long time. By the way, over the last 30 years, the best investment for a European investor would have been Italian, Portuguese, and Spanish bonds. Strangely enough, they did better than equity. Will this go on forever? No, but the Eurozone is as strong as it's ever been on a political side, and this means, of course, that Italy is amongst the strongest to perform. This is our strongest position and will remain so. Next. The next one is Betriebsgewinne. What you can see is that everybody is taking the corner. What am I showing you here? I'm showing you company results, expected company results over the next year. So the next year, we're already 12 months further. We should be out of this crisis. And this is the prognosis that's being made for the moment. Well, the most important thing is that the most important markets like USA, like Germany, that's the red line, are moving upwards. They're not yet out of the woods. It will take 2 years, 3 years before we're completely back into in the normal area. But the most of them are turning in the right side, to the right side, except for Spain and Italy, which remain very vulnerable. From a bond side, I invest there, but certainly not from an equity side. Equity, that's US, but also in Europe. Look at Switzerland. That's the red line. Behaved very well. Denmark. That's the magenta line. You should know that Denmark, I'm very enthusiastic about that country, and certainly its stock exchange. After the New York Stock Exchange FANG index and after the Chi Next, it was the third best performer worldwide. And why is that? A lot of biotechnology in there, a lot of technology in there, a lot of healthcare in there. Fantastic. It went up over 20% already this year. Next. I'm focusing here on the German. Oh, sorry about that. On the American Betriebsgewinne. What you see there is that in comparison to the previous quarter, now we're in a much more vulnerable area. The reason, of course, is that before that, everybody was down 20%. So if you were down 25%, so what? That wasn't that important. But now expectations are much higher. On average, they're up 8.5% this trimester. So if you would dare to disappoint now, you will have a very, very big blow up of your stock exchange price. That's what we've already seen in a couple of companies, like, for example, Vertex Pharmaceuticals and whatever, minus 20% on one day, because they slightly underperformed to these expectations. So the dispersion and the volatility will be very high over the next couple of weeks. But of course, as you know, if there's a lot of turbulence, there's a lot of opportunity also. Next. The next one is risk premium. You know what risk premium is? So that's the compensation that you get for risk, for future risk. The calculation is simply 1 divided by the price earnings ratio minus the interest rate, the net interest rate. What you see here is something very funny, something very strange, and this has always kept my backbone very straight over the last couple of months. The risk premium, the expected risk premium, is average. This means that the stock market is very confident on the fact that within 1 year, within 2 years, everything will be back to normal. Yes, we know there's a lot of risk from the corona side, but there's also a lot of stimulus on the economic and fiscal side. When you combine both, it averages down to an average period, and therefore a great opportunity which will give you roughly 4.5% overperformance over interest rates over the next 10 years. Also compared to 2000, for example, when interest rate, when the risk premium was zero, so certainly not the case momentarily. And for example, compared to 1987, when we had the stock market crash of 1987, of course, we're far away from that. So this is very comforting, and this helped me make the right decisions over the last couple of months. Next, please. A very important one for me, of course, when you talk about risk, you also have to talk about currency risk. So Schroeder also made reference to that. Very hard to see what is going on. Benjamin Disraeli, one of the former prime ministers of the UK, said only love has driven more men madly than the foreign exchange. So of course we have to be very, very prudent what we say. But look at the red line. That's the US dollar per euro. The higher the red line, the weaker the dollar is. And we made a model, the green line there, already 10 years ago, which I'm following, which leads me to the strange conclusion that the dollar is exactly at the level where it should be. It also helped me, as you can see, in 2020, when the dollar was far too strong, early 2020. And strangely enough, I didn't hedge that with futures. I hedged it with Polish zloty, which worked out wonderfully well, but it won't work second time. But here you can see that we are exactly at the right position where we should be. Of course, there's a lot of political turbulence going on in the next coming weeks, which could lead us up or down. But roughly speaking, we're okay. Now, this is important for me because we've got a lot of US stocks in our portfolio, so I have to look at the currency risk also. Next. Just what we are looking at is, of course, not only, this is the end of the macroeconomic slides. It's not only about Erste indeed, and it's also about risks. I'm not going to dwell on that. High volatility for the moment, but there's not too much asymmetry. Die Börsen sind nicht asymmetrisch. Das bedeutet, it simply means that the probability of a sharp decline is not that high in the markets for the moment. We can calculate that from the skewness indicator. Next. A very important aspect for me is not only on the asset allocation side, where we were fortunate enough to have a pronounced asset allocation over the last couple of months, and therefore had more equity in our portfolio. But do not make a mistake, equity markets on average did not do very well over the last couple of months. It's not because the New York Stock Exchange FANG index is up 70% that everything was up 70%. On average, an average stock is still down roughly 2% this year. Only when you had the high flyers in there, you had a good performance. That's what you have seen in the previous graphs. That's where, and of course, that's where the allocation accents, the emphasis that we put on technology, etc., worked out perfectly well, and will do so in the future. I'm absolutely sure about that. A very important aspect is, of course, also the individual selection. There we have a very specific model. I worked on this for years and years and years to come out with, because I was always convinced that we should find a way to make very coherent, outperforming selections. And I think we realized in doing that. Next. What are we looking at? We're looking at quality aspects and we're looking at value aspects, kwaliteitsaspekten und bewertungsaspekten. The quality aspect is return on assets. We don't look at return on equity, by the way. Return on equity, there's a Hebel effect in there, there's a leverage in there, which might distort your view. So we look on return on assets, Wachstumsrate, Risiko und die Wachstumsrate der Dividende. That's quality. We define that into a number of factors, and of course we look at value. We look at the price earnings ratio. We look at price to book. Mind you, we are not a value manager. We are growth managers, but growth doesn't mean that you should take unsensible prices into your portfolio. That's one of the reasons, by the way, that we do not have Tesla in our portfolio yet, because I cannot apply any of my criteria on it. There are no earnings. There will be in the near future. That's the simple reason why it's not in there. Next. Just two or three very methodological slides. Of course, you might say, who cares about that? Well, I care about that very much so. And I know a lot of my professional colleagues also care about that. What investment style are you following? What factors are you looking at to take into your model? And based on these factors, how do you come to a selection? Of course, everybody knows that you can be lucky over a certain period, have a very high historical yield, but you took a lot of risks and you're just lucky that these risks didn't realize. Of course, you have to correct for that, but you also have to correct in your models the expected returns with the expected risks. And how do you do that? That of course, that's the name of the game. That's the big tricky thing that you have to come by. Next. I'll show you very quickly what we are doing. Sorry for the mathematics in there, but everybody can understand what is going on. Of course, in the first line where you see RMT and RIT, etc., it simply means that's the return of a certain portfolio manager, and M is the return of the market. Everybody knows in the second line that at least you have to correct for the market. This will lead you to an alpha. This is the famous capital asset pricing model. But everybody also knows, every professional also knows that in practice this doesn't work very well. Yeah, the first initiation to a correction was to introduce small minus big, the famous size factor, and high minus low, that's the famous value factor. But that didn't suffice. That was not enough. It helped us in making the difference between luck and skill, Fähigkeit und Glück, but it wasn't good enough for us, because we need something which pushed up the yield also. Höhere erwartete Rendite. Next. And that's something. Next. Hello. Yeah, vielen Dank. Two elements were, sorry again for the mathematics, it's almost over, don't worry. Two elements should be brought into the equation. Momentum and Qualität. There's one problem with momentum. Momentum, that's just simply buy something that has gone up. Very strange. It's one of the best strategies. Buy something that has gone up and hold on to that portfolio for the next 12 months. The only problem with momentum is that suddenly it collapses. And when it collapses, it really brings you down. It really brings very, very steep losses. So we take momentum into consideration, but we are not building our portfolio on that. We build our portfolio on quality. There's also a next one, that's BAB, as you see, that's betting against beta. That's something we take into consideration also. So we go for low beta stocks, but low beta stocks also means that that's also something that we take into consideration for quality. So if I can go, and sorry for the mumbo jumbo here, but that's what you have when you have a professor in finance speaking. He looks at these things, but usually a professor in finance stops here. I go further, and I of course introduce that into my portfolio management. Next slide, please. This is the very last, very technical slide. Look what is going on. This is the quality factor. In theory, this is called the quality minus junk factor. If you mind looking at that, we've developed a fantastic model on that. And this is what it does. Only this. Look at the brown line. Brown line, that's the significance level. When it goes up, it means that it has brought positive, significant improvement to your portfolio. It always does, except in the 1970s. That was during the oil crisis. So yeah, sorry about that. But for the rest, when it works well and helps you. And when it doesn't work, it doesn't hurt you. You see, we stay above the zero bar. That's very important for us. So that's what we build our portfolios on. And this gives fantastic results. So from an intellectual point of view, I'm very, very happy about the model that we are following. And of course, as an investor, I'm very happy about the results that we see from that. Next. Next slide, please. Thank you. Just now, I'm very technical. What do we do? We take a factor, one of the factors that I told you about, return on assets, etc., etc. Look at the slide, from a certain company, and then we standardize that the results. You know how this works, the standardization. You take the result minus the average divided by the standard deviation. Everybody who's familiar with statistics knows what to do. So I can start adding all these factors and comparing all these factors between companies. Once that I do that, I can make a total ranking. Now, what is very important in there is that you look at all companies. There are roughly 15,000 companies out there. And the major mistake that most asset managers make, now I'm being very audacious, of course, but is to have a carve out. Most of the people will tell you, most of the private bankers and portfolio managers will tell you that they only look at 300 stocks, but do that very profoundly. But how many combinations can you make from 300 stocks out of 15,000 stocks? There must be there are more than there are stars in the sky. So you have a sort of carve out in the beginning, which will lead you to somewhere, but you don't know where. You have to look at all stocks. That's what we do. And therefore, of course, you need a very, very, very performing model. That's what we have. This gives us a gesamte percentile score where I can make my decisions on. Me and my colleagues, of course. Give you some examples here on the next graph. It's just examples. Supposingly that from your top-down analysis, you want to go into Germany, Austria, and Switzerland, and you want to go into industrial stocks. You want to go into stocks with a growth factor. Well, these would be the stocks that we go into. These are the I would say, the highest quality rated stocks for the moment. Tradegate, LEM, you know these companies better than I do. Berliner Effektenbank. What do we already have in portfolio? Partners Group, Interroll, Mayr-Melnhof. I'm currently looking at Hartmann, Lanxess, RWA, Henkel, Drillisch. Most probably this week I will start investing in these stocks. I've had some very large cash inflows and I've got the opportunity to do that. Another big German stock, another big position that we have in Germany is Atos Software, and also mentioned Maschinen Software. They're not on this list here. That's because of das Beispiel, das ich genommen habe. The next slide, please. Supposedly that a number of these stocks are too small. Of course, you have to look for liquidity, which would be the ones that we would take into portfolio. Partners Group in Switzerland, Deutsche Post, but also Lanxess, RWE, Henkel, and a couple of them which are not on this list, like Sonova, etc. Okay, so the very last one here. Okay, just go to the last slide then, please. Because I think I'm running over time. This would be the same thing. You have this in your slide package. IT sector in the US, for example, etc. With Brooks Automation, again, you see Qualys, JT Global, Cadence Design. These are all these robotics and automation firms which are coming back. Okay, next. Nanotech, that's, sorry, I'm out of time here. Nanotech, if you want to go for very small firms, next, which would be a very important thing in the future. I can also look at stocks which are highly overvalued and go short on that. I'm not yet doing that in the fund, but in the next phase we'll be doing that. Next slide, please. These are the biggest positions that we have for the moment. Of course, this practice what you preach, they say in English. What you can see coming back, Amazon, Apple. Of course, you need these stocks in your portfolio, and this was very fortunate for us to have that. Mastercard, Vestas, Novo, Nordis, all very, very good performing stocks that we've had in there. Next slide, please. Intuitive Surgical, for example. So, herzlichen Dank. Entschuldigung, dass ich nicht meine eigene Slideshow montiert habe. Aber ja, das genügt, ja. Vergessen Sie nicht, dass in die Zukunft, wenn Sie das kleinste Risiko, das geringste Risiko suchen, dann kurzfristig, dann nehmen Sie langfristig das größere Risiko. Dafür sind wir offen für Risiko, aber natürlich müssen wir immer die Rendite nachsehen. Und da glaube ich, dass wir einen guten dass das gut zusammengegeben hat. Vielen Dank.